Thanks for joining, everyone. Got great attendance. My name is Mike Kesner, managing partner at Virtus. Two esteemed guests today. My partner, John Eichmann, whose face is currently not on the screen, but we'll be able to hear him. And our CEO, Andrew Gray. So, April 15th, 4/15 is usually a rough day. People have to send a lot of money to Uncle Sam, which is uncool. But we got a deferral this year. So along with that theme, we thought we would do a webinar focusing on 4 cost-cutting ideas in the insurance space. So 4 cost-cutting ideas, strategies in 15 minutes. Besides Andrew and John, we realize most people don't want to talk about insurance for much more than 15 minutes. So we'll kind of keep it high level. Fairly brief, and then we'll get back. Any questions, feel free to just type in the questions, or we'll give you our contact information towards the end, and we'll get back to you with answers to your questions later today or tomorrow. So, like I said, Mike Kesner, Virtus, thank you everyone for joining. I'm going to toss it over to Andrew first. Andrew, if you can just give a brief introduction on yourself and maybe a minute on Virtus, then we'll throw it over to John.
Perfect. Thank you, Mike. Thanks all for attending. Glad to have you, and hopefully we can add some value today. Hope everyone and their families are doing well. Quick background on Virtus as a business. We founded our firm in 2014, commercial insurance brokerage, full scale, full spectrum. We do have definitive vertical specialization, specifically in the private equity sector. So as you know, we look at the attendees who had RSVP'd for this call. It's everyone from general partners at private equity, buyout funds, to private equity companies in the real estate sector, to management teams and financial executives within the respective portfolio companies. So appreciate all once again for jumping on. I'm going to cover the property casualty content, and we'll later cover the employee benefits content. I'm going to effectively try and keep it relatively high level because everybody's got a unique situation based on where they are from an operating perspective and where they are from size, scope of business that they're either investing in or operating. So if you have any questions, as Mike put later, we'll make sure that we circulate our contact information. I think it'll be posted at the end of this call. So really the 3 tranches I want to cover today is, Q1, where we were prior to the pandemic from a property casualty perspective and a trend perspective, the impact of the pandemic as it relates to property casualty insurances, most specifically, and then obviously the subject matter for the call is with respect to cost savings opportunities in the current environment as people look to solidify their balance sheet and cash becomes relatively, if not most. So we'll start with Q1 and where we were prior to the pandemic. So to look at the property casualty market from a rate perspective, broad base, at the end of Q1, effectively we had seen net rate increase of 4.5% across all lines of coverage. Most specifically, the coverage is affected. We continue to see a hardening of the market in the property market and the D&O market. Commercial auto remains trying with kind of continuous upward pressure. That market continues to accelerate from a rate growth perspective for numerous reasons. But the market was in general continuing its trajectory in mid-single digit, low single digit hardening. The only kind of bright spot, if you will, is the workers' compensation market was down about 2% from a rate perspective holistically. So that's where we were coming into the coronavirus pandemic. Basically, the question becomes, what was the impact? What is the impact of coronavirus as it relates to insurance? So as many people have probably explored and seen, the business interruption coverage is largely an excluded event in the property insurance program. Now, for many of you, you've seen the litigation that's been filed with relation to these business claims. This litigation is still very fresh. It is TBD as to how that will play out. The D&O market, we anticipate additional firming because of COVID. We do anticipate that there will be claims filed just simply due to the fact that business interruption insurance was not procured, and there's some challenges around that space. I wanted to touch on workers' compensation as well. Workers' compensation, generally speaking, communicable diseases are not going to be covered, but OSHA has issued guidance that COVID-19 is recordable, so more to develop there. Where there is a bright spot potentially in commercial auto, there'll be less miles driven during the slowdown, if you will. So as many of you might have seen, certainly in the personal auto market, you're seeing refunds that the carriers are giving out. We don't anticipate that on the commercial, but those refunds are being basically given out because of less miles driven. So regardless, we do expect some social inflationary impact because of the litigation filed, regardless of if any of these claims are actually worthy and have merit. Additionally, as you look at upcoming renewals, forthcoming renewals across lines of coverage, I think it's important to calculate and understand what additional exclusionary language is being embedded into the policies, because we do expect kind of holistic programmatic and policy change as it relates to some of the exclusionary language on pandemics, and just making sure that it's absolutely certain that these types of claims will not be covered going forward unless specifically intended to be. To touch just briefly on our recommendation as it relates to the business interruption claims, you know, obviously there's federal relief coming out. I'm sure most of you are in tune with that. But we have recommended to our clients to certainly track their losses as it relates to business interruption or business income. It'll be interesting to see what happens over the coming weeks and months with some of the early litigation that's been filed. Dependent on your scenario, it may or may not be warranted to file a claim at this point in the process. Certainly touch base with your brokerage, or we'd be happy to review your existing to give you intel as to what we can expect to happen. So that's generally the impact and status going into the pandemic. Really, the thought process for this call was to touch base on what can we do here and now to theoretically free up cash as our business has been impacted by the slowdown. A couple things we want to touch on. These, again, will be very high level. If you have specific requests or questions as it relates to your business, please let us know. But first and foremost, the way that we would look at any program, and suggest you do the same, is to look at the financial analysis. Very simply put, is the insurance carrier making money off of your account? Are you profitable from a loss ratio perspective, which is basically claims being paid out in contrast to premiums being paid in? That's where you get the leverage from both a alternative carrier perspective and just an increased marketability of your program. The second thing to consider, if the insurance carrier is making profit on your account, how to capture that profit. So the easiest way to think about this is, if you carry a low deductible, does it make sense to raise the deductible, compress the premium cost, which is your fixed cost, and absorb more of a variable cost as it relates to the deductible? Okay, so there's various formats that can take within your program. Presumably on this call, there's various sizes of company and management. And so thinking about, if you are on a loss sensitive or large deductible program now, how do we best mitigate those losses to capture dollars there? If you're not and are in the middle market and have the scale on the balance sheet to be able to support more of a variable cost structure, it certainly makes sense to look at it if you are, again, profitable from a financial perspective. So that's kind of the most logical starting spot for us. Secondarily, in that same vein, if you are not profitable to the insurance company, you've got more of an uphill battle to try and identify short-term cost savings. You know, less ability to the insurance carrier marketplace, probably less desire, if you look at a net cost basis, to increase those deductibles and carry some of that risk. However, dependent on the kind of liquidity of the business and the emphasis on cost reduction, there is certainly a kind of risk reward calculation as to, again, going back to the deductible analogy, taking a larger deductible and absorbing more of a variable cost. That variable cost obviously has the ability to be managed through safety, loss control claims initiatives as well. So that's where we would all start in good times and in bad, is doing that financial analysis. The other thing that I think is really important at this juncture is to do an exposure analysis. So as many people have been impacted, you've got less revenues, less employees, less payroll. Those are all underwriting basis for the insurance on a broad basis. It's really important to think about and analyze on a go forward, what are the appropriate payroll revenue characteristics of the business to underwrite to. These items are picked up at audit. So again, it's not a holistic cost savings, but it does certainly improve liquidity. And then if you do have a really strong year in contrast to what you expected your exposures to be on the front end, just ensuring that you're accruing for those and can capture those. But the only thing I'll say to be cognizant of here is if you compress those expectations too low, you're going to get an increase in the rate structure. So there is some value to scale and having higher exposures. So it's just something to be thought out, but certainly erring on the side of caution is not a bad strategy.
Andrew,
Sure.
good question. Love the fact, for everyone on the call, by the way, you might hear in the background, Andrew's got 4 kids under the age of 5. So you might hear
Door locked.
and the door's locked. Would you say now more than ever would be a good time for private equity, private investment, the actual owners to put a little bit of pressure on the portfolio companies to really dig into the insurance costs? A lot of times it's like an afterthought, but now's a time where they can say, hey, Mr. or Mrs. CFO, please spend an hour with, our insurance firm or with Andrew digging into this to really figure it out.
Well, I think that's right. I mean, when you look at the exposure analysis that I'm talking about here, so often we see it done at the 11th hour instead of really pulling back the numbers and thoughtfully projecting out, right? And in this environment, making sure that it's accurate is more probably than just simply compressing it. Again, you do have some adverse rate increase if you compress those expectations too much. But again, in the current environment, if it helps out cash flow in the short term and simply you accrue in the event that the business returns to some sort of normal economic levels, I think it certainly makes sense to really peel back that data and make sure that you're doing it accurately.
Great. Thank you. Thank you very much. John, why don't I toss it over to you? Why don't you do a quick introduction of yourself and then maybe share 3 or 4 areas where you've had some success on the exciting world of health insurance.
I appreciate that. Thank you. So yeah, I'm John Eichmann. I run our employee benefits division at Virtus, and I've been in the business over 30 years. So I've seen recessions before, but I haven't seen a recession that's been caused by a health pandemic. So this is new charted territory for all of us as well. And so actually we have spent a lot of the last probably month and a half now, not thinking about necessarily today, but thinking about what this does to tomorrow. So we've been spending time with our actuaries, really kind of building out the models that these changed times are causing. And so we're looking at things like, one, what is the cost of testing? It's minimal. What is the cost of care of the COVID-19? If somebody does get sick and they wind up in the hospital, they wind up in intensive care. So we've been doing a lot of modeling there, but even more importantly is kind of where are we going from here? So what's next? And one of the things that's really obvious is that elective procedures are not being done. In fact, the CDC came out in the middle of March, so just about a month ago, and said, don't do them. We'd rather you people not go to the hospital. We'd rather you people not be in the doctor's office. So if it's elective and it can be put off, we want you to do that now. Well, that changes our cost projections for the year, for the rest of this year. And then as we look at these elective procedures, when we get back to the new normal, as we look at these elective procedures, and how they kind of fold back into the healthcare system, how will that happen? Well, some procedures just won't happen at all. One that's glaringly obvious to me anyway is physical therapy. If somebody had been given a prescription for physical therapy for 12 weeks of therapy, and they went home and they did all of their exercises on their own, they might feel better today, and they may never go back to the physical therapist, so those problems have been solved. So those claims will be completely avoided. The other claims will surely kind of like rush back into the system, but there is a capacity issue. And they can only do so many knee replacement surgeries. They can only, scope so many knees or do some of those surgeries that are more, quote, routine in nature, but certainly elective also when you have them done. So we think we'll see those play out over the next 18 to 24 months. So what we're looking at is kind of reforecasting our budgeted plans, so self-funded plans, for the rest of this year, because those numbers that we had forecast, back in October, November of last year, they've changed. And so we're looking at how that has impacted the world. As far as cost savings ideas, kind of right now, we're spending a lot of time talking with employers about really two different things. One is, I have these furloughed employees. I know they're coming back. Can I keep them on my health plan? And if I can, what do I do? Do I pay their premiums? Can I ask them to pay premiums? And can I change plans on them mid-year? And the answer is yes, you can. Most people don't know that. Most people approach sort of the annual renewal with, I have to select plans now for the next 12 months. Well, in these times in particular, but actually in most years, if you want to change health plans, you can. And so when we study data, we know that more than half of a group usually doesn't even use the health plan. So if you changed health plans on them right now from something that's really rich to something less so, you can save money as an organization and not impact the members of the plan, just because you're changing health plans on them, paying the insurance company a lower premium. So that's very possible in these times.
John,
one of the other things that
John, would you say 50% of the CFOs and HRs out in the benefits world have no clue that they can make a change in the middle of the year if needed?
Correct. And actually, in most instances, the employee benefits renewal can be a bit painful to go through. So I certainly don't want to go through it twice, but desperate times lead to desperate measures. And what can we do? So we're trying to, quote, save our company, or we're trying to just weather the storm, if you will. And these are things that could be addressed right now. So yes, most probably don't know that they can do this. Almost all carriers will allow it. In fact, I'm sure all carriers in today's world would allow that.
Right.
For sure. So we have another client, fairly good sized. They give a very generous contribution to their HSA for each employee. It costs them about $270,000 a year. Okay, the good news is HSA accounts are extremely flexible. So they've decided to suspend payments into those accounts. They were able to get a run and see most people had what I'll call sort of a transactional amount of money in those accounts. So if they had a small claim during this time, they still have money in those accounts. In addition, the employee can put money in, or let's face it, all payments are sort of a little bit delayed right now. So if you needed to delay a payment to a doctor's office or to a hospital that you had to have, that's probably an acceptable outcome right now. So if you look at an employer saying, you know what, I'm going to suspend payments to the HSA right now to weather the storm, and I'll start them back up again once the economy opens up again and we're back to work. That's very possible. So this particular employer is going to avoid, tens of thousands of additional cash outflow right now, and then be able to start that back up again when things get normal.
Two more.
One of the other things.
That's two. I know you.
Yeah, I got it.
Two more.
Well, one of the other things that we've seen, again, this goes to what can I do mid-year? And this is actually something that we started to address prior to the virus coming to town, but it's pharmacy contracts. So we just happen to have a plan where there was a massive pharmacy issue going on, in that they had a very, very large pharmacy claim. It was eating up about 80% of all of the company's claims. And so we went to the pharmacy benefit manager and we said, this is ridiculous. We have to renegotiate this particular contract mid-year. And so what happened is that company came back with, or that we've negotiated for that company, about $100,000 savings for the rest of the year. So zero impact to the employees, we negotiated a better deal mid-year because they were open to that sort of negotiation. Then I think sort of the last thing to take a look at right now, and this comes from the market and just, kind of the market working against itself, if you will, but to our advantage, is when all of this hit, all of the non-medical carriers came out to us and said, let us help. So non-medical, think life and disability insurance. And they just came to the table with idea after idea after idea, how they can cut costs sort of mid-year. And one of them is, let us write new business right now. I get it. Most of you guys are in a 1, 2, or 3 year, guaranteed contract. They are very aggressive right now trying to write new business when it's, let's face it, it's difficult to write new business right now. But we look at life and disability insurance in particular as more of a commodity. The employee doesn't know who the insurance company is, doesn't really care. They just want to be able to, have comfort that should somebody pass away, that claim will be paid. Should somebody become disabled, that claim will be paid. So of course you want to be working with high-end carriers, but right now they're being extremely aggressive in trying to write new business when they otherwise think they probably can't or it'd be hard to. So that's another spot right there. I'm sure we could see 10 to 15% savings in the life and disability market space.
And then, very helpful, John. And then maybe touch on, I know the clients that you've worked with historically, the ones that seem to get the most bang for their buck are the ones that have, an alignment between the C-suite and the senior HR folks, kind of being driven typically by the C-suite. Would you comment on that quickly?
Yeah, some plans run efficiently, some run very efficiently, and some are just kind of upside down one way or the other. And the upside down one way or the other are those plans that are run either by finance or by HR. Those that are run very efficiently is a combination of the two. And unfortunately, we don't see a lot of that, where there's just a real good give and take between, finance has to analyze the numbers, HR is going to pull for more. I get it. It's what they're supposed to do. But that combination where those two teams work together, those are by far the most efficient plans. And what I mean by efficient, I mean the company and the members, the employees, are getting the most value for the money that's being spent.
Good stuff, John. Thank you. Andrew, if I could throw it back to you for a quick second, a little bit off the insurance topic, but more as a leader, maybe comment on one or two things that you've done to keep the morale, in our opinion, the morale is sky high at Virtus. So maybe some others could hear one or two things that you feel like you've done that has worked, maybe something that didn't, but I'm only aware of a couple of really good things that you've kind of implemented to keep the morale high at Virtus during this time.
Sure. I wouldn't say that it's an I situation, but I think our leadership team and collectively our employee population and team has responded very well. Fortuitously, we were set up to work remote and did so very quickly, and then I think that everybody on this call has certainly had challenges, right? And so we have tried to keep employee engagement high. We have attempted to have fun, and I think it's fairly obvious for even us on the leadership team that, you have good days and bad days in the current environment, and so keeping morale high. So we do a virtual lunch every Tuesday. We do a virtual coffee every Thursday, and an all hands meeting at the end of every week with fun things included. We had a talent show last week or 2 weeks ago and things of that nature, but really just trying to keep employee engagement. I think our business, we're fortuitous that, we can pretty much operate as normal other than going to the office and just a little slower on the sales and growth front. But, otherwise we've tried to keep it light and engaged. And I think certainly like everybody just have been really thoughtful and engaged on contingency planning and continue to watch and evolve literally day by day at the beginning, hour by hour. So we've had fun with as much as we can.
Yep, agreed. And then John, do you want to touch on that? You've done some good things with your team as well. Want to touch on one or two of those?
Thanks. So we get together as a team, so the benefit side of the house, just for 30 minutes every Tuesday and Thursday, really just to stay in touch. It's, just kind of tossing around the room. What are you doing? Any plans for the weekend? Just yesterday we had a call and we talked about our favorite vacations, just to keep it light, because we're in different times right now, and I refuse to believe that this is the new normal. We are going to go back to a new normal, but right now this is just something to get through. It's different. We're all going to look back and say, do you remember when we got through this? And I know we're all going to be better for it. It's typically what happens.
Cool. Thanks. You know what? It's about 3:26, so there's, we don't need to extend it to 3:30. Thank you to
plug real quick, Mike.
Yes.
So I just want to reach out to the group and let everybody know in kind of a shameless plug format. So the typical way that we would engage to help people out in this scenario is to perform a basic diligence review of your existing programs and generate what we call a cost savings hypothesis. So we can typically find savings in every deal, right? And whether or not it's prudent for the business to make that decision, that's where we work closely with the management team. But in these kind of extraordinary times, we want to position ourselves to be helpful, right? So even if there's not short-term economics to us and to our business, if we can be helpful to you, any of your portfolio companies or those management teams or managers on this call that operate portfolio companies or businesses in general, just shout at us. We're happy to help and give our 2 cents, because really, at this time period, it's all about trying to help each other out and weather the storm and progress, beneficially to all. So don't hesitate to shout at us. Happy to help and happy to, at a minimum, jump on a call and have discussion. So thank you all. Thanks, Mike, for leading the discussion, and we'll talk to everybody soon.
Cool. Why don't we sign off? Why don't we show everyone the Virtus handshake going forward, since it might be a new world. It's a V. Thanks, everyone. Bye-bye.